Shares of Nvidia crashed 6.9% on Wednesday as President Trump's trade war really extended into the tech sector, impacting Nvidia specifically with a $5.5 billion write-down the company is expecting to report in the first fiscal quarter of this year. Now, Nvidia has been under chip restrictions on what they can export to China for a number of years now. That started under the Biden administration, but the news that came out late yesterday is that the H20 chips were going to be included in those restrictions, and that's where the impact is going to come in the current quarter. But the bigger impact could be long-term for the company. This opens the door for Chinese chip makers and a software breakdown of Nvidia's Moat. That's ultimately where the company has its biggest advantages. You combine the company's chips, the way that it can connect those chips in together so that a whole bunch of chips act like one chip, and then add this software, which is CUDA and all the other pieces of CUDA that are around it. And that's why the company has such a powerful business, especially in artificial intelligence. But if you start to break that down, there's a number of huge impacts, from impacting their sales and margins to that software moat to potentially bringing more competition into the market. I'm going to dig through what exactly the impact is strategically on this announcement. As with everything in the Trump administration, this could change maybe even before this is published. But I think it's important to look at what the potential risks here are for Nvidia, because this is one of the most valuable companies in the world. About a $2.5 trillion market cap could have a huge impact on the future of artificial intelligence and technology broadly. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's go to the first problem. That's just simply sales. Nvidia not being able to sell H20 chips into China is just directly going to have an impact on their top line. Basically, it makes the pie smaller for Nvidia. But that's fundamentally going to be an issue long term because it's making the pie bigger for other chip makers, particularly in China, like Huawei. Huawei is moving up the curve and advancing their chips on all fronts, and they announced some new artificial intelligence chips recently that say that they're competitive with Nvidia. That is with the caveat that they take a lot more energy, but they're definitely getting more competitive. And if Nvidia chips can't go into China and Chinese companies need to use an alternative chip, they're going to move to a company like Huawei. That's going to improve that competition. That's going to mean those sales are going to move from Nvidia to Huawei, reducing the total addressable market and definitely having an impact on the company's business. We should also look at the geography. This is a chart that shows where Nvidia is generating its sales. Now you can see that the United States is the biggest segment, $61.3 billion worth of revenue over the past year. But the two that are most important in this context is China, which is in blue, $17.1 billion in revenue over the past year. And then Singapore, $23.7 billion in revenue. Those chips that are being sold to Singapore are most likely not ending up in data centers in Singapore. They're likely making their way through Singapore and then to China. So that's sort of the goal of the Trump administration, is to close these loopholes that are moving Nvidia chips into China and allowing them to catch up with their artificial intelligence technology. And if they start to close all of those loopholes, that's a pretty big impact. Those two segments combined $40 billion worth of potential revenue from just those two geographies. That's where we could see the potential impact. Now, not all of those sales are going to be impacted, but it could be a significant chunk of those sales are going to be impacted from restrictions like this, especially if those restrictions get stronger. And we know that some of these leading edge chips are not making their way to China, or at least shouldn't be making their way to China. So again, the total addressable market for Nvidia is smaller than it previously was if they're not able to sell these chips into China. The second problem is their software moat. I mentioned earlier that Nvidia's power in the market really comes from CUDA and everything that is around CUDA and all the software that they built to run specifically on Nvidia chips. This is going to give an incentive for Chinese AI companies to build alternatives and potentially even open source them. That's exactly what DeepSeek did. So the idea here is that if you're a competing chip maker or even a customer of Nvidia, what you want to do is you want to commoditize your complements. You want the software that Nvidia produces, CUDA and everything else, to be a commodity in the market. You want that to be basically open source so that it's not only tied to Nvidia chips. This at least gives an incentive for a huge chunk of the market, the Chinese market, to create those kind of complements. And if it's open sourced, like we saw with DeepSeek, it can be adopted broadly by the tech community. And really, there are only a handful of companies that really matter in this. Companies like Alphabet, Meta, Microsoft, and Amazon. Those are the huge customers that Nvidia needs to keep serving. It needs to keep them tied to its hardware and software ecosystem. If that tie between hardware and software starts to break down because there's now potentially open source software coming from China, it doesn't matter where it comes from. If it breaks that tie, it's going to be a reduction in their competitive moat. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The third problem is just simply competition. This kind of ties these first two things together, but this gives an opening for Chinese competitors to get into the market and gain some market share. One of the challenges in the chip industry is you can't be a small player. You have to be one of the leading players. You have to be able to create operating leverage on all of the costs that it takes to develop a chip and then actually produce a chip. If Chinese companies can do that in a way that they haven't been able to previously, that's going to give them a leg up in the market. And again, Nvidia is in a position where they own the AI market today because they have the best chips and the best ecosystem. There's no incentive for a US company or a European company to use any other ecosystem besides Nvidia. This is giving an incentive for companies in China or companies China adjacent to use Chinese chips and their ecosystem. That's competition that Nvidia does not want to have in the market. So where are we going to see this show up in the company's financial statements? This is what's going to be important to watch over the next year or two. The first thing is going to be the company's operating margins and gross margins. You can see in this chart that gross margins and operating margins both skyrocketed when we had that ChatGPT moment in 2022. Now, there were some reasons in the middle of 22 that those margins declined a little bit, but historically, Nvidia does not have a 60 to 70% operating margin. They have more like a 30% operating margin. What's happened over the past couple of years is the company's growth has been absolutely phenomenal. And coinciding with that, they've had margin expansion. So you have both of those things together and you get a much, much more profitable company and a much, much more valuable company because investors are willing to pay for growth and margin expansion. If we start to see that the total addressable market, and so therefore the growth of revenue starts to decline, that's what I was talking about earlier, that's going to be a headwind for the stock. The other thing that could be a headwind for the stock is if those margins decline. Now there's competition in the market. You have TPUs from Alphabet. Maybe there's chips from Huawei. Those are going to be sold, maybe not into the US, but globally that is going to create competition. So what if those margins start to come down? What if instead of a 73% margin, which we had in the most recent quarter, we have a 55, 60% margin? That's going to also put your operating margins lower. What if those operating margins go from 60% down to where they were historically, closer to 30%? That's going to greatly impact the company's operations and the way that the market values the stock. So right now, you look at their valuation, the price to earnings multiple on a forward basis is only about 25. That looks pretty cheap for investors. But if it turns out that we do see headwinds on both the sales side and the margin side, that could look significantly more expensive, especially if the bottom line starts to get worse. Enterprise value to sales looks far more expensive, 21. But the reason that that makes sense is because they have such incredible margins. So what we could see here in the future for Nvidia is just a slowdown of some of the trends that we've seen over the past couple of years. Maybe their growth isn't quite as strong because of this increased competition. Maybe their moat isn't quite as strong with CUDA and their software. All of this could lead to margin compression. I think that's ultimately the worry for the market right now. This is a bigger deal than you might think. You want Nvidia to be everywhere if you're an Nvidia shareholder. This move by the Trump administration not only impacts this coming quarter that they're going to be reporting, it's going to be impacting their competitive position in the future. And that's ultimately why the stock is down as much as it is today. I wouldn't be surprised if we see the stock continue to slide a bit here over the next few months, because it doesn't look like this trade war is ending anytime soon. And it looks like Nvidia is now tied up in it. That's not a great place for them to be. I am not a shareholder, but one of the upsides of a move like this in the market is as the stock drops, I get much more interested in this stock because this is a company that I would like to own, but I want to pay a no-brainer price for Nvidia shares. We may get there sometime in 2025, but let me know what you think of Nvidia today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.